Stop what you're doing. Not in a minute. Not after this sentence. Right now. Tell your dog you'll walk him later. If you're in the shower, get out and grab a towel. Close the dating app. She was never going to swipe back anyway. Are we clear? Good. Now listen very carefully. If you own silver, physical bars, coins, ETFs, futures, anything, do not look at your brokerage account until this video ends. Because if you look right now, you will either panic or celebrate, and both reactions will make you do the wrong thing. I need you calm, focused, because what I'm about to show you requires understanding, not emotion. Ladies and gentlemen, Asian guy here. It is Wednesday, January 14th, 2026, and I am about to tell you something that 24 hours ago would have sounded impossible, something that breaks the rules of modern finance and proves, mathematically, that the silver paper market is finished. Yesterday, Tuesday, January 13th, we talked about the CME's emergency move. They raised silver margin requirements by 15%. They changed the system from a fixed dollar margin to 9% of notional value. That was not routine risk management. That was desperation. The goal was simple: force retail traders to liquidate, trigger margin calls, create a sell-off, protect the banks that are massively short silver. And I told you, very clearly, it would not work. I told you the fundamentals were too strong. I told you the physical shortage was real. I told you Shanghai was still trading at a massive premium. I told you not to panic and not to sell. And that brings us to today. Because the margin hike failed, the manipulation failed, the suppression failed. In fact, it backfired. Today, the silver market did something I have never seen in my life. Something that should not be possible in a functioning global market. The Shanghai Futures Exchange closed at $104.55 per ounce. At the same time, COMEX spot silver in New York is stuck around $91.67. Let that sink in. That is a $13 gap on the same metal, on the same commodity, on the same element from the periodic table, in a real market. This cannot exist. Arbitrage traders would buy silver in New York, ship it to Shanghai, sell it for $13 more per ounce, and repeat the process until the gap closed. That is how markets always work. Except this time, they can't, because the gap isn't closing. It's widening. Yesterday, it was $8. Today, it's $13. And tomorrow, it could be $15 or $20. And the reason is the single most important thing you need to understand right now. The arbitrage is dead, not expensive, not difficult, dead. There is no metal to move. The Western vaults are empty. The silver that is supposed to back the futures contracts, the ETFs, the paper claims, it does not exist. And the system is now breaking in real time, right in front of you. In the next section, I'm going to prove this with numbers, real data, evidence that even the most skeptical viewer cannot dismiss. So stay with me. Focus. Because once you see the math, you will never look at the silver market the same way again. Let's strip away the emotion and go straight to the data. Because opinions can be argued. Narratives can be dismissed. But numbers do not lie. Politicians lie. Bankers lie. The media lies. But mathematics is truth. Yesterday, Tuesday, January 13th, the Shanghai Futures Exchange closed at $93.31 per ounce. At the same time, COMEX spot silver in New York was trading around $85. That alone created a spread of $8.31. That was already historic. That was already abnormal. That was already proof that something was breaking. But what happened today pushed this market beyond anything I thought was possible. Today, Wednesday, January 14th, the Shanghai PM session closed at $104.55 per ounce. Let me repeat that. $104.55. That is an $11 move in less than 24 hours. An 11 to 12% single-day surge in a commodity that is supposed to be stable. A metal the mainstream still claims is not money. That kind of move does not happen in normal markets. It happens in currency crises. It happens when governments lose control of pricing. It happens right before systems fail. Meanwhile, New York did move higher. COMEX silver climbed from $85 to roughly $91.67. But it did not keep pace, not even close. That leaves us with a spread of $12.88. Let's round it to $13. A $13 premium on a fungible commodity that should trade at the same price everywhere on Earth. In finance, when you see a gap like this, it means one of two things. Either A, there is a breakdown in logistics, or B, there is a breakdown in supply. So let's deal with logistics first. Can silver be shipped from New York to Shanghai? Yes. Planes are flying. Ships are sailing. The infrastructure exists. This is not a transportation problem. That leaves supply. And this is where the story turns fatal for the paper market. When banks and traders attempt to source physical silver in the West, to ship it east and capture the spread, they hit a wall. The vaults are empty. Dealers are sold out. Mints are backlogged for weeks. Available inventory simply does not exist. And even if a bank manages to locate some metal, there's another problem. Once silver enters China, it cannot come back out. As of January 1st, export licensing rules went into effect. Silver flows into China freely, but leaving requires government approval. And those approvals are not being granted. So the arbitrage is not just unprofitable. It is one-way and irreversible. Ship silver to Shanghai and it's gone. That destroys the mechanism that keeps global prices aligned. And this is why the spread isn't narrowing. It's accelerating. $8 became 13. 13 will become more. Because the bridge between East and West has collapsed. We are no longer dealing with one global silver market. We now have two separate markets, a Western paper market priced by futures, ETFs, and leverage, an Eastern physical market priced by real buyers taking delivery. One is trading claims. The other is trading metal. And the $13 spread is the mathematical proof that these two worlds are no longer connected. In the next section, I'm going to explain why this spread is unprecedented, how it compares to other commodities, and why it signals outright market failure, not volatility. I need you to understand just how extreme this situation is. A $13 spread on silver is not unusual. It is not a little distorted. It is not temporary volatility. It is a market failure. In a functioning commodity market, price differences between major exchanges are measured in cents, not dollars. Gold trades between London and New York with a spread usually under 50 cents. Copper, even during supply disruptions, might see $1 or $2 between exchanges. Oil, wheat, corn, the same story. These markets correct themselves automatically because arbitrage enforces reality. Silver has always followed the same rule. Until now, a $13 divergence on silver represents a 14% price difference on the same asset, at the same moment, across two major global markets. That is not noise. That is the pricing mechanism breaking down, and the trajectory matters just as much as the size. 2 weeks ago, the spread was around $5. Last week, it widened to $7. On Monday, it hit $8. Today, it's $13. That is not random. That is acceleration. And accelerating spreads tell you something critical. The market is losing confidence in its own pricing. This is what it looks like when a paper system collides with a physical constraint. Because here is the uncomfortable truth. The COMEX price is not failing because of speculation. It is failing because delivery is no longer credible. The paper market only works if participants believe that contracts can be settled in metal if demanded. Once that belief disappears, the price becomes fiction. And that belief is disappearing fast. COMEX registered inventory is now hovering around 30 million ounces. That sounds large until you realize that the open interest represents hundreds of millions of ounces. Multiple paper claims exist on every single ounce. That means the market is functioning on fractional reserve silver. As long as most players settle in cash, the illusion holds. But once physical demand rises, once players start standing for delivery, the math collapses. And that is exactly what we are watching unfold. The Shanghai price is telling you what silver costs when delivery is mandatory. The COMEX price is telling you what silver costs when settlement is optional. Those are not the same thing anymore. This is why calling the paper price manipulated is actually underselling the problem. This is not just manipulation. This is structural insolvency. The system promised more metal than it could ever deliver. And now, as demand surges, the promise is being tested and failing. Which brings us to the most important question. If the spread is this large, why aren't the big banks exploiting it? Why isn't JP Morgan buying at $91 and selling at $104? Why isn't every trading desk on Wall Street printing risk-free money? Because they can't. And in the next section, I'm going to show you exactly why, step by step, and why this traps the banks in a position they cannot escape. This is the question every serious trader asks the moment they see a spread like this. Why don't the banks just buy silver in New York, ship it to Shanghai, and collect $13 per ounce in risk-free profit? In a normal market, that is exactly what would happen. But this market is no longer normal. There are three hard barriers that make this arbitrage impossible, and together, they form a trap the banks cannot escape. First, they do not have the metal. Western vaults are effectively drained. COMEX registered inventory sits around 30 million ounces, while open interest represents several hundred million ounces of paper claims. That means there are multiple owners on every ounce. When banks try to source physical silver, they discover the same thing retail buyers are discovering. It's already spoken for. Bars are pledged. Inventory is rehypothecated. Metal has been sold multiple times on paper. The moment large players try to convert claims into delivery, the shortage becomes visible and the price explodes. Second, even if they find metal, they can't bring it back. Since January 1st, silver entering China is effectively trapped. Export licenses are required to remove silver from the country, and those licenses are not being issued. This turns arbitrage into a one-way door. Ship metal to Shanghai, and you're paid in yuan, but the silver stays inside China. That creates two problems at once. The bank cannot retrieve the metal if conditions change. The capital received cannot be freely converted and repatriated due to controls. So even a successful trade strands capital and inventory inside China. For a global bank, that is not arbitrage, that is risk. Third, and this is the fatal one, the banks are short. They are not neutral observers. They are not opportunistic traders. They are structurally short silver after decades of suppressing the price through paper contracts. Buying physical silver would push the COMEX price higher. Shipping it east would widen the spread further. Both actions would accelerate their own losses. In other words, closing the arbitrage would destroy them. So they do nothing. And when arbitrage dies, price discovery dies with it. This is why the spread is widening instead of narrowing. This is why we are in uncharted territory. The market has fractured into two realities. A Western market, governed by leverage and cash settlement. An Eastern market governed by delivery and scarcity, and there is no longer a mechanism to reconnect them. In the next section, I'm going to explain what this means for the banks themselves, why their short positions are becoming existential threats, and why this is no longer just a silver story, but a systemic one. Now we get to the part Wall Street does not want discussed, because this is no longer about silver as a commodity. This is about balance sheets, solvency, and systemic risk. The major bullion banks, JP Morgan, HSBC, Scotia, and others, have been structurally short silver for years. This is not speculation. This is documented history. They have been fined. They have been charged. They have admitted to spoofing and manipulation. But they kept doing it anyway. Why? Because for decades, it worked. When silver was at $20, they sold paper and bought it back lower. When it hit $30, they did the same. When it ran toward $50, they doubled down. Every rally was crushed. Every spike was faded. And the system survived because physical demand never overwhelmed paper supply. Until now. Today, silver is $91 in New York, $104 in Shanghai, and $132 in India. The banks are short from $30, $50, $70. And here is the critical difference between shorting a stock and shorting a physical commodity. When you short a stock, the worst case is limited. The stock can go to zero, and you make money. When you short a commodity that people need, a commodity with industrial demand, no substitute, and no inventory, there is no upper limit. The loss is theoretically infinite. And now the banks are discovering the nightmare scenario. They cannot buy back their shorts. Not because the price is high, but because the metal is gone. Shanghai is paying over $100 and still cannot source enough supply. India is paying 45% premiums and still facing shortages. Mints are backlogged. Dealers are empty. So how do you close a short position when there is nothing to buy? You dump. You stall. You suppress. You lobby regulators. You force margin hikes. You pray for panic selling. And when that fails, you face two options, both catastrophic. Option 1, force majeure, cash settlement. Paper contracts declared undeliverable. Confidence in futures markets destroyed overnight. That doesn't just kill silver trading. It destroys trust in all paper markets. Option 2, let the price run. Let silver find its real price. $150, $200, $300. That means trillions in losses across interconnected bank balance sheets. Losses large enough to trigger margin calls, downgrades, and cascading failures. Either path breaks something. And that is why the banks are dangerous right now. Cornered institutions don't behave rationally. They behave desperately. Which is why what you're seeing next is not just volatility. It is endgame behavior. In the final section, I'm going to show you how this connects to gold, bonds, the dollar, and why this silver event is a signal of a much larger breakdown already in motion, and what that means for you. Now zoom out, because this is not just a silver story. Silver is simply the first place the system cracked. Gold just hit a new all-time high at $4,644. That is not speculation. That is a confidence collapse. U.S. Treasury. Yields are spiking above 4.5%, which means bonds are being sold. Global capital is dumping government debt. Why? Because trust in fiat currency is eroding. The Federal Reserve is trapped. Raise rates and the debt implodes. Cut rates and the dollar collapses. Print money and hard assets explode. There is no clean exit. And the East sees it clearly. That is why silver is $104 in Shanghai and $132 in India, and still unavailable. This is what happens when people with long historical memory stop trusting paper. They don't debate. They buy metal. So what does this mean for you? If you own physical silver, do not sell. The number on your screen is not the price. The real price is what buyers pay when delivery matters, and that price is already much higher. If you own ETFs, understand the risk. Cash settlement is legal. Paper pays the paper price, even when physical trades far above it. If you hold futures, ask yourself one question. Do you trust COMEX delivery when the spread keeps widening? Because force majeure means a check, not metal. If you don't own silver, The question is no longer should I buy? It's can I still buy? Availability is disappearing faster than price is rising. Yes, the paper market will fight back. Margin hikes, volatility, fake sell-offs. COMEX may dip briefly, but the physical market will not. And then something breaks, a delivery failure, a sovereign buyer, an industrial shortage. When that happens, price won't creep higher. It will gap violently, because once confidence breaks, repricing is instant. And that brings us back to the $13 spread. That spread is not noise. It is proof. Proof the paper market is insolvent. Proof the banks are trapped. Proof the repricing has already begun. Paper is losing control. Physical is in charge.